Okay, so you want to own a car wash. You've driven past them 100 times, seen the line of cars snaking around the block on a Saturday morning, watched cars roll in dirty and come out clean in under 5 minutes. You think, low labor, automated equipment, people need this every week, and I don't have to deal with perishable inventory or complicated menus. You collect your money, you go home. The machine does the work. Sounds simple. It is not simple. Here's the actual story. The car wash industry in the United States is a $14 to $15 billion market, according to IBISWorld, and it has attracted more private equity capital in the last decade than almost any other service business sector of its size. Billionaires have bought car wash chains, pension funds have invested, REITs have gotten involved, and yet, the largest privately held car wash operator in the country filed for Chapter 11 bankruptcy in February 2025, with $654 million in funded debt and just $1 million in cash on hand. That gap between how simple this business looks from the road and how structurally complex it is underneath is what this entire video is about. We're going to walk through what it actually costs to buy in, where the money really comes from, what the fixed cost structure looks like, and what specific mechanism has repeatedly turned profitable car washes into financial crises. Because this industry has a trapdoor built into its most appealing feature, and most buyers don't find it until they're already on the other side. Before we talk numbers, let's reframe what a car wash actually sells. The obvious answer is, it sells clean cars. But that's not the real product. A car wash is a subscription business that uses car washing as the delivery mechanism. That reframe sounds like a Silicon Valley pitch. It is actually the precise description of how the modern car wash industry operates and how the most sophisticated operators think about it. The express tunnel car wash, the dominant model today, is not a transaction business. It's a recurring revenue engine. The car is just the excuse. The membership is the product. The customer who pays $35 a month to wash their car unlimited times is worth an entirely different amount to you than the customer who pays $15 for a single wash. Not because they wash more, they do, usually 3 to 4 times per month, but because their revenue arrives regardless of whether they actually show up. You have already collected it. It's on a credit card. It doesn't depend on the weather. This distinction is the financial architecture of the entire business. Every major decision, location selection, equipment choice, pricing structure, valuation methodology, flows from this one fact. A car wash with 2,000 active monthly members at $35 per month is generating $70,000 per month in recurring revenue before a single non-member customer pulls in. That's $840,000 per year in baseline revenue you can model, plan around, and borrow against. The transaction-based car wash next door, doing the same volume in single-ticket sales, has $840,000 in revenue that could vanish in a rainy month. Same building, completely different financial animal. Keep that frame in mind. It explains everything that follows, including exactly how this industry's greatest strength became its most dangerous vulnerability. Let's start with what it costs to get in, because the range is enormous and most people underestimate it badly. There are 3 meaningful formats. Self-serve car washes, the kind with individual bays where you spray your own car, are the entry-level option. A multi-bay self-serve facility costs between $250,000 and $700,000 to build or acquire, depending on location and how many bays you have. Revenue is limited. A self-serve bay washes 15 to 30 cars per day at $5 to $8 per wash. Annual revenue per bay runs roughly $40,000 to $100,000. Margins are high because labor is essentially zero, but the total dollar profit is modest. You're not getting rich off a 2-bay self-serve in a suburb. In-bay automatic car washes, the drive-through rollover style where the equipment moves around a stationary car, land in the $250,000 to $700,000 per bay range, with annual revenue per bay running $139,000 to $500,000 depending on pricing and volume. These are better businesses than self-serve, and many still function as standalone investments, but they're increasingly being squeezed by the format that has eaten the industry. That format is the express tunnel car wash. A car enters a conveyor system, travels through a 100 to 150-foot tunnel of automated cleaning equipment, and exits in 3 to 5 minutes. No employees touch the car. No hand drying. No interior work. Just a fast, automated exterior wash in volume. A well-sited express tunnel processes hundreds of cars per day. At an average ticket of $15 to $20 per wash, a busy single-site location can generate $1.5 million to $4 million in annual revenue. Building a new express tunnel car wash from the ground up, land, construction, equipment, soft costs, runs $2.5 million to $7 million depending on land cost and market. Equipment alone, the conveyor system, pumps, spray arches, blowers, water reclaim systems, accounts for 40 to 60% of the project cost, typically $1.4 million to $2.1 million for the tunnel system alone, according to industry advisors at Car Wash Advisory. Land in a prime suburban location with 25,000 to 40,000 vehicles per day passing by, which is the minimum traffic count any serious express operator wants, can run $500,000 to $2 million or more depending on market. In a major metropolitan area, land costs alone can equal or exceed the equipment budget. If you're buying an existing operation rather than building, valuations are set by EBITDA multiples, earnings before interest, taxes, depreciation, and amortization. According to Biz Buy Sell and Car Wash Advisory, independent car washes currently trade at 4 to 7 times EBITDA. A car wash generating $800,000 in EBITDA at an 8x multiple, which was common during the peak of the private equity boom, cost $6.4 million. During that peak, some express tunnels in premium locations were transacting at 12 to 15 times EBITDA. The median sale price for a car wash listed on Biz Buy Sell is approximately $857,000, but that median is heavily weighted towards smaller self-serve and in-bay operations. A serious express tunnel acquisition is a multi-million-dollar transaction. Before that tunnel washes a single car, there's a stack of pre-launch costs that don't appear in the brochure. Environmental compliance is the one that surprises new operators most. Car wash wastewater contains hydrocarbons, heavy metals, detergents, and oil residue from vehicle surfaces, all regulated under the Federal Clean Water Act. A car wash cannot discharge its wash water into a storm drain. It must send wastewater to a sanitary sewer system after treatment, or reclaim and reuse the water on site. A traditional tunnel system without reclaim uses 85 to 120 gallons of fresh water per vehicle. Modern reclaim systems reduce that to 30 to 45 gallons by filtering and recycling the water, saving significant cost on water bills at scale, but requiring a water reclaim system that adds $50,000 to $300,000 to your construction budget. In California and other states with strict environmental oversight, a reclaim system isn't optional. It's required by regulation. Beyond the water systems, you'll need permits from multiple regulatory bodies before you open. The building permit and site development approval can take 6 to 18 months in a competitive jurisdiction. A business license, health and safety compliance certification, and zoning approval for the specific use add additional time and legal fees, typically $10,000 to $50,000 in combined professional fees, depending on market complexity. Phase 1 and Phase 2 environmental assessments, required by any responsible lender as part of due diligence, add $3,000 to $15,000 more. General liability insurance for a car wash runs $15,000 to $30,000 per year for a mid-size express operation, with property insurance on top of that. Water and sewer connection fees, the one-time charges municipalities levy to hook a commercial facility into the municipal water and sewer system, can run $20,000 to $100,000 depending on the local utility and the capacity your facility requires. In drought-prone markets like Arizona or California, a car wash may also face time-of-use pricing penalties, mandatory water audits, and requirements to demonstrate water conservation measures before receiving permits. And oil water separators, devices that filter petroleum-based contaminants from your wash water before it enters the sewer, must be installed, inspected, and the waste they collect must be hauled by a licensed contractor on a regular schedule. That hauling service adds roughly $2,000 to $8,000 per year in ongoing compliance costs. You are, in short, running a commercial water treatment operation inside a car cleaning facility. Most people don't think about it that way, The EPA, however, does. Now let's talk about where the money comes from. Because the revenue model of a modern express tunnel is genuinely layered, and each layer has different economics. The first and most important revenue stream is unlimited membership subscriptions. A well-run express tunnel converts 30 to 50% of its regular customers to monthly memberships. These members pay $25 to $45 per month, often in tiers, with a basic exterior wash at the low end and a premium wash with wax, ceramic sealant, and tire shine at the high end. Monthly cancellation rates on these memberships typically run 3 to 6%, meaning your members are sticky. They stay. A location with 2,000 active members at an average of $35 per month generates $840,000 in annual recurring revenue, completely independent of daily customer count or weather conditions. According to the Zips Car Wash bankruptcy filings in 2025, membership revenue represented over 2/3 of the company's total revenue across 260 locations. Mr. Car Wash, the industry's only publicly traded company, reports similar membership concentration, roughly 76% of its wash sales driven by subscription members. The second stream is paper wash transactional revenue, single-visit customers who choose not to join. A well-priced basic tunnel wash runs $12 to $18 for a single visit. On a strong day, a busy location might process 400 to 600 cars. At $15 average ticket with 60% of customers being members, who've already paid monthly, the remaining transactional revenue is still meaningful, roughly $4,500 to $9,000 in daily non-member revenue on a high-volume day. This is the weather-sensitive component. Rain does not prevent members from being charged. Rain absolutely prevents transactional customers from showing up. The third stream is add-ons and upgrades. At the point of payment, whether via a kiosk, a mobile app, or a staffed attendant, customers are offered package upgrades: tire shine, wheel cleaning, interior fragrance, rain-repellent ceramic coating. The incremental cost to the operator for most of these add-ons is 50 cents to $2 per application. A customer who upgrades from a $12 basic wash to a $22 premium package is generating roughly $9 in additional revenue at a cost of about $1.50, a contribution margin of approximately 83% on the upsell. Express tunnel operators who consistently sell add-ons to 40 to 60% of their transactional customers can increase average ticket revenue by 25 to 35% with almost no additional labor. The fourth stream, increasingly common, is detailing services. Some express tunnels attach a detailing bay, hand waxing, interior vacuuming, window treatment, paint correction that commands $50 to $300 per service. Margins are lower here because labor is the primary input, but detailing creates a revenue layer for customers who want something more than the automated tunnel provides, and it captures premium customers who might otherwise go to a dedicated detail shop. Put all four streams together and a mature, well-located express tunnel generating $2 million to $2.5 million annually, a reasonable figure for a solid mid-market location, looks like this. Roughly $1 million to $1.4 million from memberships, $400,000 to $700,000 from transactional washes, $150,000 from add-ons, and $100,000 or more from detailing. The membership stream is the spine. Everything else is additive. Here is where the math gets serious, because the cost of simply existing in this business, before serving a single customer, is formidable. Labor is the largest operating cost for a staffed tunnel operation. An express tunnel with a modest crew of 6 to 8 per shift, running 2 shifts a day, carries payroll of roughly $150,000 to $250,000 per year, depending on market wage rates, which in most metropolitan areas now run $14 to $18 per hour for attendants and $18 to $25 for shift managers. Water and electricity together run $2,000 to $8,000 per month, depending on volume, location, and whether you have a reclaim system. Chemicals, the soaps, waxes, pre-soaks, foaming agents, and sealants that go into every wash cost roughly 50 cents to $1.75 per car, which sounds negligible until you multiply it by 150,000 to 200,000 washes per year at a busy location. At $1.25 per car and 150,000 cars annually, That's $187,500 per year in chemicals alone. Equipment maintenance, and this is the one operators consistently underestimate, should be budgeted at 5 to 8% of revenue annually, according to multiple industry guides. On a $2 million revenue location, that's $100,000 to $160,000 per year. The conveyor system, the brushes and curtains, the chemical injectors, the dryers, the reclaim filters, the point-of-sale kiosks, all of it requires constant preventive maintenance and periodic replacement. A tunnel breakdown during Saturday peak hours can mean $5,000 to $15,000 in lost revenue in a single day, not counting the lost members who become dissatisfied with service reliability and cancel their subscriptions. Property taxes on a prime commercial corner location, which is what a well-sited car wash sits on, run $30,000 to $80,000 or more per year, depending on jurisdiction and assessed value. This is a fixed cost. It does not move with your revenue. Insurance, including general liability, commercial property, and workers' compensation, runs $15,000 to $35,000 annually for a mid-size operation. Credit card processing fees, on a business where nearly every transaction is card or app-based, run approximately 2.5 to 3% of revenue. On a $2 million operation, that's $50,000 to $60,000 per year flowing to payment processors. Added up across a typical express tunnel doing $2 million in annual revenue, and total operating costs, labor, utilities, chemicals, maintenance, insurance, taxes, processing fees, run roughly $1.1 million to $1.4 million to REF per year before debt service. Net operating income, or EBITDA, on a well-run express tunnel at this scale lands around 35 to 50% of revenue, which is genuinely strong for a service business. On $2 million gross, that's roughly $700,000 to $1 million in EBITDA. Net profit after debt service. On a $4 million acquisition financed at, say, 70% leverage with a $2.8 million loan at 7% over 10 years, puts you somewhere in the range of $400,000 to $600,000 per year in free cash flow after payments. That's the business at its best. Here's the payback math. If you acquire a car wash for $4 million in total cost, financing $2.8 million and putting in $1.2 million in equity, and you net $400,000 to $600,000 in annual free cash flow, you recover your equity investment in roughly 2 to 3 years. That's the pitch. And in a clean, simple scenario, it's real. But there is a trapdoor. The trapdoor in this business is not the weather. It is not the competition. It is not the cost of chemicals or the complexity of water regulation. The trapdoor is the subscription model itself. Specifically, what happens when you use subscription revenue to justify enormous debt loads, and then the environment changes? Here's how it works. Because membership revenue is recurring and predictable, lenders and private equity buyers have historically been willing to value express car wash businesses at very high EBITDA multiples, sometimes 10x, 12x, even 15x EBITDA during the peak of the 2020-2022 investment boom. At those multiples, the debt required to complete an acquisition is enormous relative to the actual cash flow of the business. And most of that debt is floating rate, meaning the interest rate fluctuates with market conditions. When interest rates were effectively zero, this was fine. A $600 million debt load on a car wash platform became a crisis when the Federal Reserve raised rates aggressively in 2022 and 2023. The same debt, at a higher interest rate, required dramatically more cash to service, cash that was no longer available for operations or growth. Zips Car Wash is the most documented example of precisely this mechanism in the car wash industry. Founded in 2004 in Arkansas as a 2-location operation, Zips grew steadily for 15 years. In 2020, private equity firm Atlantic Street Capital acquired majority control and began an aggressive expansion program, assembling a chain of over 260 locations across 23 states under the Zips, JetBright, and Rocket Express brands. In 2022, Atlantic Street formed a $1.1 billion single-asset continuation fund specifically to fund further acquisitions. The logic was straightforward. Zips had approximately 625,000 Unlimited Wash Club members, generating more than 2/3 of the company's annual revenue, of approximately $303 million. Recurring revenue. Predictable, scalable, the kind of business lenders love. The capital structure that funded this expansion included approximately $653.9 million in funded term loans, plus preferred equity totaling roughly $300 million, nearly $1 billion in total obligations against a business generating around $303 million in annual revenue. When interest rates rose, Zips's annual cash interest expense surged from $59 million in 2022 to $93 million in 2023, an increase of $34 million in a single year, directly from the Federal Reserve's rate decisions. That $34 million doesn't come from revenue growth. It comes from cash the business would otherwise use to maintain equipment, invest in member retention, or simply stay liquid. Simultaneously, over 900 new car wash locations opened annually across the industry for several consecutive years, intensifying competition in Zips's core markets. Membership churn increased as customers had more nearby alternatives. Hurricane Helene in September 2024 compounded the damage, affecting more than 120 of Zips's roughly 260 locations and reducing revenue in what should have been a strong fall season. With only $1 million in cash by the filing date, against $654 million in maturing debt, Zips filed for Chapter 11 bankruptcy protection on February 5, 2025. The outcome: lenders took control through a debt-for-equity swap, approximately $279 million in funded debt was eliminated, and Atlantic Street Capital's equity, including over $108 million in rescue financing they'd injected between July 2023 and early 2025, was entirely wiped out. The business survived, the investors did not. What failed Zips was not the subscription model. The subscription model worked. Over 625,000 members were paying monthly. What failed was the leverage ratio applied to that model. The decision to borrow multiples of EBITDA at floating rates during a period of artificially low interest rates, then run the machine at full speed into a rate environment no one had modeled. The subscriptions stayed on their credit cards. The debt payments did not. Two scenarios. Same single-site express tunnel. Same market, different year. A good year. The location washes 175,000 cars. Average revenue per car, across memberships and transactional washes, is $14. Annual gross revenue, $2.45 million. Operating costs, labor, utilities, chemicals, maintenance at the high end of benchmarks, insurance, property taxes, credit card fees, $1.35 million. EBITDA, $1.1 million, a 45% margin. Annual debt service on a $3 million acquisition loan at 7% over 10 years, approximately $418,000. Net cash flow, $682,000. That's a very strong single-site performance. You are recovering your down payment quickly and building real wealth. A bad year. Interest rates on your floating rate debt have risen. Membership churn has accelerated. 3 new competing tunnels opened within 5 miles. Weather in your market was unusually rainy for 3 months, suppressing transactional revenue. A conveyor motor failure required a $65,000 unplanned repair. Wash volume drops to 130,000 cars. Average revenue per car, with fewer transactional customers, dips to $12.50. Annual gross revenue, $1.625 million. Operating costs, including the repair, $1.115 million. EBITDA, $475,000. A 29% margin, still not catastrophic as a standalone figure. But the debt service hasn't changed. It's still $418,000. Net cash flow, $57,000. You have cleared $57,000 on a multi-million-dollar investment, and you have no financial cushion for whatever comes next. The difference between those 2 years is $625,000 in cash flow. On a business where the fixed cost structure is locked in, property taxes, insurance, debt service, minimum staffing levels, a 20% decline in revenue erodes 90% of your free cash flow. If that bad year involves rising floating rate interest, the $418,000 debt service becomes $550,000. Your $57,000 becomes negative. That is not a hypothetical stress scenario. That is precisely what happened at scale to Zips. and to other PE-backed operators who applied the same leverage playbook. So why do sophisticated investors keep buying car washes? Even after watching Zips and the broader 2023-2024 industry correction, acquisition activity has not stopped. It has simply repriced. First, the real estate. A well-located car wash sits on a prime commercial corner that was carefully selected for high traffic count, visibility, and ease of access. That land, typically 1 to 2 acres on a major arterial road, appreciates independently of how well the business performs. Operators who own rather than lease their land are building an appreciating real estate asset alongside the business. Some sophisticated investors use sale-leaseback transactions, selling the real estate to a right and leasing it back, to free up capital while retaining operational control. The underlying land in a top suburban market is worth holding for a decade, regardless of what happens to car wash margins. Second, the tax structure. Car wash equipment, the conveyor, the pumps, the arches, the point-of-sale systems, depreciates on an accelerated schedule. A $2 million equipment package might generate $400,000 to $600,000 in annual depreciation deductions in the early years, sheltering a significant portion of operating income from federal taxes. For a high-income investor looking to offset ordinary income, a car wash is a legitimate and time-tested tax vehicle. Third, the automation thesis. An express tunnel with strong membership penetration runs largely without owner involvement. The equipment washes the cars. The subscription billing system collects the payments. The POS kiosks handle transactions. You need a manager on site and a maintenance relationship with an equipment vendor. But the business does not require your daily presence in the way that a restaurant or retail store does. This is the part that gets overstated in marketing materials, but it is not entirely wrong. A well-run express tunnel is closer to owning a self-managing real estate asset than it is to running a traditional service business. Return to the reframe. A car wash is a subscription business that uses car washing as the delivery mechanism. That's the intellectual elegance of the model, and the precise location of its structural risk. The moment you understand a car wash as a recurring revenue business, you understand why private equity values it like software, borrows against it like real estate, and then watches it blow up when the debt becomes expensive. Subscription revenue is stable until the debt that financed it is not. The independent operator who owns a single well-located express tunnel, no venture capital, no private equity, a sensible SBA loan at a fixed rate, 2,000 loyal members paying every month, is running a genuinely good business. The same business bought at 15 times EBITDA with floating rate debt from a private credit fund is a financial instrument wearing a car wash costume. Same equipment, same members, same revenue, completely different risk profile. The car wash on the corner of the busy intersection is not selling you clean cars. It is selling investors a theory about the durability of small monthly payments and the compounding value of habitual behavior. When the theory holds, and it usually does, for the person running a single site with discipline and reasonable leverage, it is one of the steadiest cash flow businesses in American commerce. When the theory is stretched too far, mortgaged too heavily, and subjected to rising rates and saturating markets, the subscriptions keep flowing in, right up until the bankruptcy filing. The machine still runs. The debt is what breaks.